Mrs. Klingman.
Mr. Martinez.
Good to see you.
Good to see you. Have you
So
been there, done that?
Yeah, I was going to say, been there, done that. Yeah, sort of. Yeah, I know. So that could be a lot of things, but I know we were talking about our first experience getting into business for ourselves separately, in eons ago,
Yeah.
and you were telling me this awesome story about golf clubs, but I'll tell you my super truncated version. So I'm a musician. We don't golf. I'm sorry. I mean, God bless those of you out there who do both, but like that's not me. So a friend of mine gave me his golf clubs, and the first time I actually went to use them, and I had to like buy a bag because I was carrying around golf clubs. First time I went to use them, it was like a foursome, situation, and I teed off, and the head of my driver went further than the ball. I mean, it was comedic relief. So yeah, I'm pretty bad.
Yeah. But golf clubs were actually my first business expense because I got into business really young and I had never taken a business class, and I heard all business happened on the golf course. So I assumed I obviously needed golf clubs.
Of course.
20 years later, I still have those clubs. Don't have the bag. It got a little moldy in a flood, but and all but two of those clubs still have the saran wrap on them, like on the heads. Like I literally never use them.
Nice, great
So
years
I
of
can
your
now
life.
attest you do not need golf clubs to be good at business, but you
But
also,
how that
not a
how's it
great choice of expenses.
exactly? And I know, hey, I know you've done this and I've done this. It's just like, do I need that? Not really, but whatever. It's a tax write-off. It's a business expense. But I know we've talked about this, that how you run your business, your financials for taxes and for building value in your company so you can sell it are two different things. So let's talk seller's discretionary earnings and about those add back or expenses and how that affects you.
Yeah, because sellers' discretionary earnings is all that money that you're spending on things that a buyer wouldn't have to spend on going forward, right? So those are one-time expenses, maybe investments in software, things like that. But it's also travel, and it's sometimes your automobile, and sometimes you're paying for your cell phone and you're paying for your family's cell phone and things like that.
We
But
don't do that. Whatever, man.
I mean, there's those expenses that a buyer wouldn't necessarily have to have going forward. You may use cable for your business purposes, but your buyer may not need that. And so they expect some of those add backs. We expect to add back officer salaries, things like that. Obviously, the EBITDA, interest, taxes, depreciation, and amortization. But we also add back things that, again, those expenses that just aren't a buyer would not have to do because it increases your bottom line. The challenge is that from a tax perspective, we want to write off as much as possible, right? So most of us want to pay as little taxes legally as possible. And in doing that, we oftentimes put ourselves in a position of now we've written off so much that our tax implications are really low, but it also makes us look like we didn't make any money. So that becomes really difficult when we go to sell. If you have a very small number or a negative number and we're adding back, 75 to 95% of the sales price is really add backs, that's really difficult to justify and certainly not financeable.
Yeah, no, and definitely if that buyer is trying to get SBA financing and they really want to see nice clean P&Ls and such over the last profit and loss statements over the last few years. So yeah, something to consider. I know, as when I was running my business, I didn't think about that. It was all about taxes. So yeah. Cool,
Yeah.
man.
And again, things that you can write off. I take clients out. We belong to a boat club. We take clients out on the boat club. It's well within the realm of being able to be written off. But if I were going to go sell my business, that's an expense that starts to get sticky in terms of, is that really something that a buyer would want to pay for going forward? It's an add back. But at the same time, if I'm doing a lot of those things and, I just want to keep it in line, definitely under 50% and really more like 25%. Ideally, we don't want to be adding back more than that. Another just thing to keep in mind is if you have a type of business that you're able to use your cost of goods for things, so you're paying for cost of goods that don't have an invoice attached to them or don't have a bill attached to them, income coming in, It's important to keep track of that too, because that number gets buried and we don't have a way of showing that you used those, some of those cost of goods were for your personal, if you have a air conditioning company and you put an air conditioner into your own house, you're not billing yourself, right? In
Correct.
theory.
Yeah.
So there's labor and cost of goods costs. It's going to make it look like it costs more to run your business than it did. So it's keeping track of, there's nothing wrong with doing that, but it's keeping track of it.
Yeah. Yeah. No, that's great advice, especially those kinds of things that we just take for granted and use our own stuff. So cool. Well, I mean, and rule of thumb, 2 years.
Yes,
Before you go to sell, make sure your financials are clean. 2 years, and of
years.
course we're happy to take a look at that and give some suggestions beforehand. I mean, I wish every seller would talk to us long before they want to sell, because that
Yes.
would really it would help everybody out. So
Absolutely. There's definitely things you can be doing now to get ready for a sale in the future.
awesome. Thank you, Jamie Klingman.
Thank you, Sam Martinez. Have a good one.
You too.